Hello investors and traders, today I'll speak about 3 dividend stocks to buy in 2023. Happy New Year for everyone, and let's start to make money and earn dividends in this year. So the first stock for today is WB8 Wolverine Boots Alliance. We can see that its current price is 37 bucks using the Elliott wave. So what I'm see on the chart that for last 10 years we were trading in a range, the range between 36 bucks to 19, and using the Elliott waves. In my mind it was the first five, the second, the third, the fourth, and the fifth. So most probably from this lower border of this range may start see a bounce, because by the way, the momentum indicator, the RSI in the weekly time frame is 46, telling us that and there is a nice probability to see this stock higher in this year. The burgeoning interest in WBA is likely has to do with the company's multi-point growth strategy that hinges on boosting its organic growth rate. WBA is tackling this task in 2 days. So to begin with, it's investing heavily in a variety of designation incentive designed to promote online purchases and drive through pickup. Although most of the WBA sales will come from its brick and mortar stores, the pandemic was a teaching moment for management of the importance and convenience of having a beefed up online presence. Let's have a look on its fundamental parameters. We can see the total score is 84, quite high score. The marginality, the gross is 21, net margin is 3, so it's profitable company. The interest coverage is more than 2, not so high, but I think it's quite enough for this company. The valuation, now we can see the valuation is very cheap. P ratio only 7, NPS is 24 cent. The average P ratio now for S&P 500 is 15, so WBA is twice cheaper than the whole index companies. And the dividend yield is currently more than 5%. The company continued to show growing its dividend rate. The last 3 years it more than 2%. Also here we have a nice chart. We can see that most of its revenue the company earns in the US retail pharmacy, 82%, the international segment is 16%, and US healthcare is less than 2%. The gross marginality is 21%, and also the company has net interest income, but no matter. But please pay attention that the SG&A is and the total operating expense are quite significant amount. The SG&A is selling generally expensive. The tickets on all the bonuses, the rents, the leasing usually is you can find it here in SG&A. So this 20% of the total operating expenses. The second stock for today is Ford Motors. So let's have a look on it fundamental on its chart. We can see that in my mind last 2 years we were trading in the range between 11 and 60 bucks. Now we are in the major support level in the lower border of this range. So by the way, in the weekly time frame their size only 40, so we can see that now this stock is oversold. Let's have a look on the Ford fundamental parameters. We can see that the marginality is 15% gross, the net margin is about 6%, interest coverage not so high, so it can maybe it can be a problem, but pay attention that the EBITDA ratio is 6. Also it can be dangerous, but now P ratio is only 5 as PS less than 1, a very cheap stock for me. And the projections for the future, the net income will grow about 20%, and the revenue will continue to grow about more than 4%. Also, the current ratio and quick ratio, the liquidity ratio is higher than 1. So in the near term, I don't see that any problems with this company. The forward dividend yield 5%, and please pay attention that the dividend payout only 20%. It means that only 20% from its net income the company pays as dividends. So there is huge potential for Ford to continue to increase its dividend payments to its shareholders. Here we can see that the most revenue come from the automotive segment. Also, Ford has Ford Credit and the mobility. Let me say a few words about Ford. There is nice possibility to grow in this year. This is why, because the excitement surrounding Ford can likely be traced to 3 factors. The first is Ford's sizable investment in electric vehicles and batteries. Ford plans to spend a cumulative about $50 billion throughout 2026 on EV and battery research, with the goal of launching 30 new EV models worldwide by the end of 2025. This EV replacement cycle should be an organic growth driver that lasts for decades. Secondly, but without question, building on the previous point, Ford has established a presence in China, the #1 auto market in the world. If estimates prove accurate, and more than half of all vehicle sales in China are powered by alternative energy in 2035, Ford has a massive overseas opportunity to boost its sales and profits. And the last stock for today, it's AT&T with the ticker T. Yeah, ticker is here. So it's Dividend King, Dividend Stock Run. It's a stock that I'm personally continue to hold in my portfolio for this year, for the next year. So the Elliott waves here telling me that here we're in impulse in my mind. Here it was the first wave, the second, the third, and now we are in a correction. Most probably here the correction is finishing. Here it was ABC move, another ABC, and now most probably we are finishing the last ABC move. Here is the third wave. By the way, here the major support level for the last 20 years. So now I'm expecting to see another impulse. It can be the wave 5, and it will be higher. Most probably it would be higher than $40. So there is nice potential to grow, of course, for AT&T from this level. I remind you that I have a lot of videos about dividend stocks, fundamental and technical analysis of stock market. And if you still didn't subscribe to my channel, so press the like button and subscribe now. And let's have a look on the AT&T fundamental parameters. Here we can see that it's the strongest and the most financial stable company. The debt-to-EBITDA ratio is less than 3, interest coverage about 4. And here we can see that the ratio of debt to equity is about 1. So from the 3 stocks for today, AT&T is the most safest. Here it's a profitable company, gross margin higher than 50, net margin 12, and the valuation also. All the 3 stocks in the video today very cheap. They have P ratio about 6, about 7, NPS price per share is less than 1. It means that for 83 cents you can buy $1 of revenue of this company. And the dividend, of course, now it's very the dividend yield is higher than 6%. The company continued to increase its dividend payment, and the dividend payout is only half. So the company, I think, will continue to pay its dividend, to increase its dividend. So for me it's a very good sign that AT&T will continue to stay a dividend king. So it was a video about 3 dividend stocks for the beginning 2023, for January 2023 WBA. Personally, hold this stock in my portfolio. It's a uh, healthcare company, and it has its own pharmacy, and the payout ratio is you can see it here is really very low. AT&T also I'm holding for 2 or 3 last years. I'm holding in my portfolio, continue to receive nice dividends, and also this company I think has a nice potential to grow. And fourth, with it EV strategy, its expansion to the Chinese market, I think Ford also now it's not a expensive stock. From technical analysis, we can see that now it's trading in the support level, major support level for the last 2 years. So also with the dividend higher than 5%, I think also it can be very interesting company. So if you like this video, press the like button. If you still don't subscribe to my channel, so please subscribe. I have a lot of videos about dividends, stock market analysis. So I hope that my channel, it will be your gate for a safe and good investing in this year. So thank you for watching, and see you on the next time. Bye.